Critical Man Pictures presents the Forex video training series. Red Belt, Trading Breakouts. When trading breakouts, you must realize that there are two main types, continuation breakouts and reversal breakouts. Knowing what type of breakout you are seeing will help you make sense of what is actually happening in the big picture of the market. Breakouts are significant because they indicate a change in the supply and demand of the currency pair you are trading. This change in sentiment can cause extensive moves that provide excellent opportunity for you to grab pips. Sometimes, when there is an extensive move in one direction, the market will often take a breather. This occurs when buyers or sellers pause to see what they should do next. As a result, you will see a period of range-bound movement called consolidation. If traders decide that the initial trend was the right decision, and continue to push the price in the same direction, the result is a continuation breakout. Just think of it as a continuation of the original trend. Reversal breakouts start in the same way as continuation breakouts in the fact that after a long trend, there tends to be a pause or consolidation. The only difference is that after this consolidation, traders decide that the trend is exhausted and push the price in the opposite or reverse direction. As a result, you now have what is called a reversal breakout. Now, we know by now that there are times when the market says, fuck you, and does what it wants, contrary to reason. The market can fake you out as well as producing false breakouts. False breakouts occur when the price breaks past a certain level, support, resistance, triangle, trendline, etc., but doesn't continue to accelerate in that direction. Instead, what you might have seen was a short spike followed by the price moving back into its trading range. A good way to enter on a breakout is to wait until the price retraces back to the original breakout level and then see if it bounces to create a new high or low, depending on which direction you're trading. Another way to combat fakeouts is by not taking the first breakout you see. By waiting to see if the price will continue to move in your intended direction, you give yourself a better chance of taking a profitable trade. The downside to this is that you may miss out on some trades in which the price moves quickly without any hesitation. Just like breakouts on your face, the nice thing about breakout trading is that opportunities are pretty easy to spot with the naked eye. Unlike the former, you don't even have to look in the mirror. Once you start getting used to the signs of breakouts, you'll be able to spot good potential trades fairly quickly. By now, you should be accustomed to looking at charts and recognize familiar patterns that indicate a reversal breakout. Here are just a few. Double top, bottom, head and shoulders, triple top, bottom. In addition to chart patterns, there are several tools and indicators that you can use to supplement your case for a reversal breakout. The first way to spot possible breakout is to draw trend lines on a chart. To draw a trend line, you simply look at the chart and draw a line that goes with the current trend. When drawing trend lines, it's best if you can connect at least two tops or bottoms together. The more tops and bottoms that connect, the stronger the trend line. So how can you use trend lines to your advantage? When the price approaches your trend line, only two things can happen. The price can either bounce off the trend line and continue the trend, or the price could break out through the trend line and cause a reversal. We want to take advantage of that breakout. Looking at the price is not enough, however. This is where using one or more of the indicators mentioned earlier in the lesson could help you tremendously. Notice, as the euro-dollar broke the trend line, MACD was showing bearish momentum. Using this information, we can safely say the breakout will continue to push the euro down, and as traders, we should short this pair. Another way to spot breakout opportunities is to draw trend channels. Drawing trend channels are almost the same way as drawing trend lines, except that after you draw a trend line, you should have to add the other side. Channels are useful because you can spot breakouts on either direction of the trend. The approach is similar. How we approach trend lines is that we wait for the price to reach one of the channel lines and look at the indicators to help us make our decision. Notice that the MACD was showing strong bearish momentum as the euro-dollar broke below the lower line of the trend channel. This would have been a good sign to go short on the pair. The third way you can spot breakout opportunities is by looking for triangles. Triangles are formed when the market price starts off volatile and begins to consolidate into a tight range. Our goal is to position ourselves when the market consolidates so we can capture a move when a breakout occurs. There are three types of triangles: the ascending triangle, descending triangle, and symmetrical triangle. Ascending triangles form when resistance level and the market price continue to make higher highs. This is a sign that the bulls are slowly trying to gain momentum over the bears. The story behind the ascending triangle is that each time a price reaches a certain high, there are several traders who are convinced about selling that level, resulting in the price dropping back down. On the other hand, there are several traders who believe the price should be higher, and as the price begins to drop, buy higher than the previous low. The result is a struggle between the bears and bulls, which ultimately converges into an ultimate showdown. What we are looking for is a breakout to the upside, since ascending triangles are generally bullish signals. When we see a breach of the resistance level, the proper decision would be to go long on the pair. Descending triangles are basically the opposite of ascending triangles. Sellers are continuing to put pressure on the buyers, and as a result, we start to see lower highs met by a strong support level. Descending triangles are generally bearish signals. To take advantage of this, our goal is to position ourselves to go short should the price break out below the support level. The third type of triangle is symmetrical triangle. Rather than having a horizontal support or resistance level, both the bulls and bears create higher lows and lower highs and form an apex somewhere in the middle. Unlike the ascending and descending triangles, which are generally bullish and bearish signals respectively, symmetrical triangles have no directional bias. You must be ready to take a trade breakout on either side. In the case of the symmetrical triangle, you want to position yourself to be ready for both an upside or downside breakout. This would be a perfect time to use the one cancels other or OCO order.